How can we deal with non-performing loans in practice? We discussed the current scenario for debt management activities in Europe, including the real estate NPL stocks and the most recent regulatory initiatives, with Laurence Bogni Bartholmé, Chief Risk Officer at Lowell Group. This podcast was recorded at a European University Institute in April 2019, in the occasion of an executive training course held by the Florence School of Banking and Finance on the topic of non-performing exposures, management tools, supervisory profiles, and policy goals. Thank you very much for your time and your availability to participate in this activity. You spoke today at this course on non-performing exposures, and the first question for this podcast would be, could you provide a snapshot of the current situation of debt purchase activities in Europe?
Yeah, so the debt management, I would say the debt management, because within the debt management, you've got the debt purchase and the debt collections, is a market which is still under development. It's progressing, but it's also consolidating. So you've got a few actors on the market. You had recent merger as well. So that becomes a competitive market, but that's also an industry where the development of the technology and the digitization is something that is very important, because, at the end, what you really want to do is to reduce the amount of the debt by, improving the collection efficiency, whether you have purchased the debt or you are doing outsourcing for bank or other companies. Really what matters is the way you're collecting and to be able to have effectiveness and efficiency in your collections.
Indeed, and for actors in the debt collection industry, what are their options and processes that are available for managing non-performing loans?
So I would say basically they have three options. One is just to manage it internally with their own teams. The other one is to outsource the NPL management and collections. And the third possibility is to sell the NPLs. So the first one, I would say, is just what has happened during many, many years, but now with the pressure that you have on reducing the NPLs on your assets, there is really a willingness to reduce the amount of NPLs. This is not a core activity for a bank. A bank is used to manage portfolio to underwrite, but when something goes wrong, the workout, it's not always, just their product experience, but also it's time consuming. And you need to have team and a lot of people to collect the money. The outsourcing part of the NPL is really where you're outsourcing all the services to companies who are used to that. This is their core product. So I would say the efficiency they're going to do it and the recovery percentage is generally going to be higher. And then obviously, if you want to reduce your assets from your NPLs, which has a positive impact on your liquidity and capital adequacy ratio and also on your leverage, then you can sell these NPLs to this company.
Moving on to discussing the standards, how has the introduction of IFRS 9 impacted on the management of non-performing loans accounting?
Well, I think the IFRS 9, which has come into effect in January 2018, so we will really see, I would say, the results for the company publishing their accounts now, is that you have an earlier recognition of delinquent assets. You're not just looking at the amount of days past dues, but you're looking at your, future expected loss. So that means that potentially the stock of NPLs is going to increase. So that means that, obviously it has an impact on the bank liquidity ratio and capital allocation costs.
Moving on to the final part of your presentation, you introduce real estate NPL-based stocks. How can we deal with them?
Well, I would say the first thing is that to deal with NPL is not to have NPLs. So it sounds weird, but I would say it really starts with your underwriting. It's really start with, your advance rate and making sure that if I take the example of the mortgage, for instance, that you're financing at a level and to consumer who can either afford it or that you have a way to really use your collaterals. and reduce the potential NPL. So that, I would say, this is the first step where you can work on the root cause. Then once you have, these non-performing loans, what I would say for the real estate is that the first thing is really to engage with the consumers, with the real estate owner. This is really the best way to find a solution. In many or most of the cases, you deal with, let's say for the mortgages again, with consumer who may have temporary issue, having lost their job, having illness or something, where in that case you just need to restructure the loan. And then I would say as well that you need to look at, again, the way you have underwritten your NPL and be fair. That means that if you have made a mistake, you need to take that into account and then maybe do settlement with the consumer where maybe they have been not forced, because you're not forcing the people, but at the same time, they may have had the view that they could afford, and if you have not done it properly, then you want to go to a settlement. I would say that's potentially the best solution if you can either settle or restructure the loan. And then obviously you would go through a legal action through solicitors if you want to repossess. But I would say normally you should take that action for really the worst case situation and just make sure that you're able to reduce your workout or your delinquent account by more proactive work.
Finally, from your practical experience, what is your assessment of the regulatory initiatives and their implementation so far, such as, for example, the NPL package?
It's really necessary that, we go through the NPL and that we've got a view of reducing the non-performing exposure in the banks. So I think that what is being done from a regulatory standpoint is very important. But we also need to look at the root cause. And we also need to look at what are the biased action that could be taken from the fact that you're putting way more pressure on the NPLs by the fact that the banks or even companies, generally speaking, have a lot of pressure on their capital allocations, on the funding cost, so that they don't take any initiative that would indeed reduce the NPLs, but would not, their NPL in their books, but would not reduce the overall stock of NPL. So what you want to do is that you want to come to a point where every year the amount of new NPL is decreasing. So you need to look at the root cause as well. Why do we have these NPLs?
And that's a very big question. Thank you very much for your time.
Thank you for having listened to this podcast by the Florence School of Banking and Finance. For more information and to listen to all our podcasts, visit the webpage fbf.ui.eu/podcasts.